There's a very strange thing happening in crypto right now. Bitcoin is back around the $80,000 area. Ethereum has exploded higher. Institutional money is coming back. ETF flows are accelerating. And yet, according to two of the most closely watched voices in the market, the move we are seeing may not be the real story, because Matt Hougan of Bitwise and Tom Lee of Fundstrat and BitMine are looking at something much bigger. Something that has very little to do with whether Bitcoin moves another 5% this week, and everything to do with what happens when institutional capital, treasury liquidity, tokenization, artificial intelligence, and crypto infrastructure begin moving in the same direction. So here's the question. Could Bitcoin and Ethereum make another major move before September? And more importantly, what has to happen first? Because if Hougan and Lee are right, the trigger may already be developing underneath the surface. And we're going to break down exactly what they're seeing. Before we go further, quick disclaimer. This video is for informational and educational purposes only. Nothing here is financial advice. Crypto is volatile, unpredictable, and can move against every prediction on this list. Please do your own research and only risk what you can genuinely afford to lose. Now, if you're new here, welcome to the Wealth Continuum, where we break down the money moves that actually matter, without the hype and without the noise. If that sounds like your kind of channel, sticking around for the next 20 minutes is going to make a lot of sense, because what we're about to walk through connects Wall Street, the Federal Reserve, artificial intelligence, and two assets that most people still think are just speculative internet money. So here's the real question we're answering today. Could Bitcoin and Ethereum make another major move before the calendar flips to September? And more importantly, what actually has to happen first for that move to be real instead of another trap? Quick question before we dive in, just so I know who's actually watching this instead of scrolling past it. Drop a comment and tell me, are you watching this on your lunch break right before bed, or are you supposed to be doing something else entirely right now? I read these, so don't be shy. Let's start with Bitcoin, because Bitcoin is where this entire story begins. As of this morning, Bitcoin is trading around $79,000. That's after a wild stretch where it pushed above $81,000 earlier this week, got hit by a hotter than expected inflation print out of the United States, and pulled back into the high 70,000s. For context, Bitcoin's all-time high sits at roughly $126,198, set back on the 6th of October, 2025. So we are still well below the peak, but we are also nowhere near the bottom either. Now here's where it gets interesting, and this is coming directly from Matt Hougan, the Chief Investment Officer at Bitwise. In his most recent interview, Hougan didn't just say Bitcoin is going up. That would be lazy analysis, and frankly, you've heard that 1,000 times from 1,000 different accounts. What Hougan actually said was far more structural. He described Bitcoin right now as coiled to the upside, and the reasoning behind that word choice matters more than the word itself. Think about how Bitcoin has historically behaved. A major hack happens and the price gets crushed. A regulator says something negative and the price gets crushed. A large holder dumps their position and the price gets crushed. That's been the pattern for over a decade. Bad news equals lower prices, simple as that. But something has shifted. Bitcoin has recently absorbed a series of negative headlines without producing the kind of catastrophic reaction that traders would normally expect. And that detail matters more than people realize. Here's why. Markets rarely reveal their true strength when everything is going smoothly. They reveal their true strength when something goes wrong and the price simply refuses to fall apart. If bad news stops producing lower prices, that tells you the sellers may already be exhausted. It tells you the fear has already been absorbed. And it tells you that underneath the surface, something else might be quietly building. Stay with me here, because this next part is where the story gets a lot bigger than just Bitcoin bounced. The crypto market of 2026 is not the crypto market of 2021. Back then, the marginal buyer was a retail trader sitting on their phone during a lunch break, refreshing a chart every few minutes. Today, the marginal buyer looks completely different. It's wealth managers, it's institutions, it's asset allocators sitting inside massive financial platforms deciding where trillions of dollars eventually go. And that changes the entire question we should be asking. Hougan has specifically pointed to the enormous pool of wealth sitting inside wealth management platforms across the United States alone. The old question used to be, does Wall Street even believe in Bitcoin? That question is basically settled at this point. The new question is completely different. It's how much of Wall Street's capital eventually gets an allocation to digital assets? Those two questions are not the same thing, and the gap between them is where the real opportunity lives. Even a small shift in allocation from institutions that manage tens of trillions of dollars combined could represent an enormous wave of demand hitting a market that is, relatively speaking, still tiny. Bitcoin's entire market capitalization right now sits somewhere around $1.3 trillion. That sounds massive until you compare it to the size of global wealth management assets, which dwarf that number many times over. Now here's a question for you. If even 1% of global wealth management assets rotated into Bitcoin over the next few years, what do you think that would do to the price? Type your guess in the comments. I want to see how many of you actually do the math versus how many of you just guess to the moon. But Bitcoin isn't the only asset on this radar. And this is where things start to get genuinely fascinating, because a completely separate thesis is unfolding for Ethereum, and it comes from a different heavyweight entirely. Tom Lee from Fundstrat and BitMine has been building arguably the most aggressive Ethereum thesis on Wall Street right now. But here's the part that actually matters. It's not simply his price target, it's the reasoning behind it. Lee's core argument is that Ethereum is transforming into infrastructure, not merely a cryptocurrency, not merely a speculative token that traders flip for quick gains. Infrastructure in the same way that payment rails or cloud servers are infrastructure. During his appearance on the Bankless podcast on the 24th of August, Lee discussed BitMine's accumulation of nearly 5% of Ethereum's total circulating supply, and he laid out his broader thesis around Ethereum's growing role in tokenization, artificial intelligence, and financial settlement. Let that sink in for a second. One firm has been quietly accumulating a position that now represents close to 1 out of every 20 Ethereum tokens in existence. That is not a small speculative bet. That is a firm positioning itself around a belief that Ethereum becomes something far bigger than what it is today. Here's where the Bitcoin versus Ethereum debate gets a lot more interesting and honestly, a lot less binary than most people think. Bitcoin is increasingly being treated as a scarce monetary asset, something closer to digital gold. Ethereum is increasingly being treated as a programmable financial infrastructure layer, something closer to digital plumbing for the entire financial system. And here's the key insight that a lot of investors miss. If both of those narratives keep strengthening at the same time, you don't necessarily need one to replace the other. They can attract completely different pools of capital from completely different types of investors for completely different reasons. Bitcoin captures the monetary and scarcity story. Ethereum captures the settlement, tokenization, and application story. Tom Lee believes that second story could become enormous. And when you look at what's actually happening on Wall Street right now, it's hard to dismiss that outright. Stocks are being tokenized, bonds are being tokenized, private assets are slowly migrating on-chain. Stablecoins continue expanding at a rapid pace. Financial institutions increasingly want blockchain rails that never sleep, that settle continuously, 24 hours a day, 7 days a week, without waiting for a traditional clearing system to open on a Monday morning. So ask yourself this question honestly. Which blockchain do you think ends up processing the bulk of that activity? Lee's answer is essentially Ethereum, and his latest argument pushes even further into territory most analysts haven't fully priced in yet. Here's what a lot of headlines are glossing over. Lee is now connecting Ethereum's future not just to tokenized finance, but to artificial intelligence itself. Why would an AI-driven economy need a blockchain at all? Because an AI-heavy economy could eventually involve enormous volumes of machine-to-machine transactions. Picture autonomous AI agents interacting directly with financial systems. Automated payments happening without a human clicking confirm. Automated settlement between systems that never sleep. Tokenized assets moving instantly. Stablecoins settling value in real time. Digital identities verifying who or what is actually initiating a transaction. Programmable financial contracts executing themselves based on conditions being met. Ethereum could potentially sit underneath a meaningful slice of that activity. Now, I want to be careful here, because this is exactly where hype tends to run ahead of reality. That doesn't mean every single AI transaction automatically creates demand for ETH. It doesn't work that way, and anyone telling you it's guaranteed is selling you a narrative, not analysis. This is where we need to separate the bullish thesis from a guaranteed outcome, because those are two very different things. But if Ethereum genuinely becomes one of the major settlement layers underneath tokenized finance and AI-driven commerce, the entire investment narrative shifts. You're no longer asking, how many people are actively using Ethereum today? You're asking, how much total financial activity could eventually run through Ethereum's rails? That is a dramatically bigger question, and it's exactly why Lee remains so aggressively bullish. In that same Bankless interview, Lee said that if Ethereum is truly entering a new bull cycle, it should trade above $5,000 within the next 1 to 2 years. And he went even further, arguing that layering Wall Street tokenization demand on top of AI-driven demand could eventually push Ethereum above $10,000. Now, pause on that for a second, because Ethereum is currently trading around $2,500. That means Lee's base case alone implies roughly a doubling from here, and his more aggressive case implies something closer to a fourfold move. Those are massive numbers, and I want you to hold on to some healthy skepticism while we keep walking through this, because big price targets are easy to say and much harder to actually deliver. Here's an honest question for you to sit with. Do you believe Ethereum can realistically hit $5,000 within the next 2 years? Comment yes if you're in that camp, or comment no if you think that target is too aggressive. I genuinely want to see where this audience stands because the split might surprise you. Let's bring this back to our original question. Could Bitcoin and Ethereum explode before September? I want to be very clear about something. Neither Hougan nor Lee is handing us a guarantee that says this happens next week. That's not how any of this works. And if someone tells you they know the exact date of the next major move, you should probably stop listening to them immediately. The real point is that the underlying conditions are shifting. And that distinction matters enormously. Markets don't usually explode because one analyst goes on a podcast and says Bitcoin is bullish. They explode when multiple forces suddenly align at the same moment, creating a kind of pressure that eventually has nowhere else to go but up. And right now, several of those forces genuinely do appear to be moving in the same direction at once. First, ETF demand. Second, institutional adoption. Third, shifting expectations around United States monetary policy. Fourth, developments in the treasury market. Fifth, regulatory progress. Sixth, stablecoin expansion. Seventh, tokenization activity from major financial institutions. And eighth, a potentially renewed appetite for risk across crypto broadly. This is exactly why the recent Bitcoin move matters so much, even with the pullback we've seen over the last couple of days. Bitcoin pushed above $81,000 before retreating, while Ethereum also moved sharply higher during that same stretch. Recent reporting has pointed to stronger ETF demand, softer bond yields, a weaker dollar, and expectations around treasury buyback activity as part of the backdrop driving that move. But here's the danger, and I want you to really sit with this part. When an asset jumps more than 20% in a matter of days, which is roughly what Bitcoin did before this pullback, everyone suddenly becomes bullish. Timelines fill up with "I told you so" posts. That's exactly the moment you need to be the most careful, not the least careful. Because a powerful rally like that creates two completely different possibilities. And right now, we genuinely don't know which one we're living through. Scenario 1, this is the beginning of a larger, sustained trend. Scenario 2, this is simply a violent relief rally happening inside a broader, choppier range that hasn't actually broken yet. This is where it gets really concerning if you're not paying attention to the right signals, because chasing scenario 1 when you're actually inside scenario 2 is how a lot of portfolios get hurt. So what would actually push Bitcoin and Ethereum into another leg higher from here? Let's break this down piece by piece because this is the part of the video I really want you to remember. Catalyst number 1 is ETF flows. This might be the most straightforward trigger of them all. If Bitcoin and Ethereum ETFs keep receiving large net inflows while prices hold their ground, the market gets a powerful feedback loop going. Money comes in, prices rise, confidence improves, more investors allocate, and prices rise again. It becomes self-reinforcing. There's another layer here that's easy to miss. Institutional investors rarely move all their capital at once. They tend to build positions gradually over weeks and months, not in a single afternoon. That means ETF flows can stay powerful even after the initial media excitement completely fades away. This is precisely why Hougan's institutional thesis matters so much. Crypto doesn't need every single investor on the planet to become a maximalist overnight. It only needs crypto to become a legitimate, boring line item inside more portfolios. That is a dramatically lower bar to clear. Catalyst number 2 is the macro environment. Bitcoin and Ethereum remain extremely sensitive to liquidity conditions. When yields fall, when the dollar weakens, when financial conditions loosen up generally, risk assets tend to benefit across the board. Recent Treasury actions have added another layer to this conversation entirely. The United States Treasury has announced plans to increase long-term bond buybacks beginning in September, and that has already fueled debate among analysts about liquidity conditions and what some are calling financial repression. Now, don't confuse Treasury buybacks with the Federal Reserve simply printing new money. Those are not the same mechanism, and conflating them is a common mistake. But markets can still interpret changes in Treasury operations through a broader liquidity lens, whether that interpretation is technically precise or not. And if that coincides with easier expectations around Federal Reserve policy, the entire setup becomes significantly more interesting. Which brings us to catalyst number 3, regulation. Crypto has spent years fighting through uncertainty on this front. Will institutions actually be allowed to participate at scale? What happens to stablecoins under future rules? What happens to tokenized securities? Which digital assets get classified as commodities? And which get classified as securities? Who even has jurisdiction over any of this? Every incremental improvement in regulatory clarity potentially removes one more barrier standing between institutional capital and full participation. And this is another area where the current cycle genuinely looks different from previous ones. The conversation is gradually shifting from should crypto even exist toward how exactly should crypto fit inside the existing financial system. That is a massive psychological shift, even if it doesn't always make headlines. Now let's talk specifically about Ethereum, because there's something happening here that could end up being extremely important, and it doesn't get nearly enough coverage. Ethereum ETFs have started attracting renewed attention over the past few weeks. Recent reporting noted that United States-listed Ethereum ETFs recorded their strongest daily inflow in roughly 10 months, something Tom Lee specifically described as a good sign for the broader thesis. That detail matters more than it might seem at first glance. Ethereum needs demand in a way that's slightly different from Bitcoin. The network itself can become incredible infrastructure underneath the financial system, but investors still need an actual reason to own the token called ETH, separate from just using the network. Lee's thesis is that this reason is becoming increasingly obvious with each passing month. Ethereum could become the settlement layer for tokenized assets across Wall Street. And if major financial institutions tokenize trillions of dollars worth of assets over the coming years, the potential addressable market becomes dramatically larger than today's entire crypto market combined. This is really the key distinction between the two theses we've covered today. Bitcoin's story is largely about scarcity and monetary properties, something fixed and finite in a world of expanding money supply. Ethereum's story is increasingly about utility layered on top of monetary properties, something that generates value from actual usage, not just from being scarce. The combination could eventually create a completely different valuation framework than what current crypto investors are used to applying. Here's the biggest question hanging over all of this. What happens if Bitcoin and Ethereum both start attracting serious institutional capital at exactly the same time? That's the scenario almost nobody wants to underestimate right now. Picture it for a second. Bitcoin breaking meaningfully higher, Ethereum outperforming on a relative basis, ETF inflows accelerating simultaneously across both assets, Treasury yields easing off their highs, the dollar weakening against major currencies, regulatory uncertainty continuing to fall, stablecoin supply expanding rapidly, and Wall Street continuing to tokenize real-world assets at an accelerating pace. None of these factors individually guarantees a rally on its own, but markets don't really operate on individual catalysts in isolation. They operate on combinations of catalysts arriving together, and when several of them line up at once, that's typically when moves become genuinely explosive rather than just another choppy trading week. This is why the next few weeks matter so much, and I don't say that lightly. Not because September is some kind of magical date carved into stone. It isn't. And anyone treating a calendar month like a guaranteed catalyst is oversimplifying things. But because the market is genuinely approaching a period where several macro catalysts and crypto-specific catalysts could realistically collide within a short window of time. There's another reason to pay close attention here. Tom Lee recently argued that the broader crypto market may already be close to the end of its bottoming process. In that same bankless discussion, he suggested Bitcoin may have already established a local low and that the market could be much closer to the end of that bottoming phase than most investors currently realize. If that turns out to be accurate, the biggest risk isn't necessarily buying too early. The biggest risk could actually be waiting around for perfect confirmation that never arrives in the way you're expecting. Because markets rarely, if ever, give investors a perfectly clean confirmation signal at the exact best possible price. By the time everyone agrees the bottom is definitely, unquestionably in, the market may have already moved significantly higher without you. But we need balance here, and I'm not going to skip past the bearish case just because it's less exciting to talk about. There is absolutely still a bearish scenario, and you need to genuinely understand it before making any decisions of your own. If ETF inflows fade out, if macro conditions tighten unexpectedly, if yields rise sharply from here, if the dollar strengthens aggressively, or if regulatory momentum stalls out after all this recent progress, the entire setup we just walked through can weaken quickly. Bitcoin can absolutely reject higher levels again and again. Ethereum can underperform for extended stretches. And leverage in these markets can amplify every single move in both directions without warning. This is exactly why I don't want you walking away from this video thinking Tom Lee said ETH is going higher, so ETH is definitely going higher. That's not analysis. That's just repeating someone else's opinion back to yourself and calling it a conclusion. The better takeaway here is this. The fundamental setup is becoming increasingly difficult for serious investors to ignore, regardless of which direction prices move over the next few weeks. Hougan sees institutional adoption and wealth platform access as the driving force. Lee sees Ethereum becoming genuine infrastructure for tokenization and artificial intelligence as the driving force. And the market is beginning to show real signs that both of those narratives are attracting actual capital, not just attention. That last part is the important piece. Narratives are cheap. Anyone can say anything on a podcast. Capital moving is not cheap, and it doesn't lie the way words sometimes do. When real money starts following a narrative instead of just talking about it, that's typically when a market's character genuinely starts to change. So let's bring everything together into something you can actually use. What would I personally be watching between now and the start of September? Number one, Bitcoin ETF net flows. Not just one single strong day that gets celebrated on social media. Look specifically for persistence over multiple consecutive weeks. Number two, Ethereum ETF flows. This one might honestly be even more important than Bitcoin's flows right now because Ethereum is actively trying to establish a brand new institutional identity for itself, separate from just being Bitcoin's little brother. Number three, the relative strength relationship between Bitcoin and Ethereum. If Ethereum keeps outperforming Bitcoin during a broader crypto rally, that could indicate investors are moving beyond the simple digital gold trade and into something more nuanced. Number four, treasury yields and the dollar. If both continue moving in a direction that supports risk assets generally, crypto could benefit as part of that broader move, even without any crypto-specific news at all. Number five, stablecoin growth. Stablecoins effectively function as liquidity infrastructure underneath the entire crypto market. If supply and usage keep accelerating, that can signal expanding on-chain financial activity happening beneath the surface, well before it shows up in price. Number six, tokenization announcements from major financial institutions. This is where Tom Lee's thesis genuinely gets interesting to watch in real time. Because if tokenization keeps accelerating across Wall Street, Ethereum becomes something much bigger than just another crypto asset on a watch list. It becomes an actual piece of financial infrastructure that institutions depend on. And number seven, price reaction to bad news. This one comes directly back to Matt Hougan's core thinking from earlier in this video. Watch what Bitcoin does the next time something genuinely negative happens in this space. Does it collapse the way it always used to? Or does it shrug the news off and keep holding its ground? Because strength in markets is often revealed through reaction, not through calm, quiet periods. If Bitcoin keeps absorbing negative headlines and refuses to break down meaningfully, that tells you something real about where we actually stand. It suggests sellers may be running out of ammunition. And if that happens, while institutional demand remains strong at the same time, you could genuinely have the ingredients for another breakout sitting right in front of you. So, could Bitcoin and Ethereum explode before September arrives? Honestly, nobody can know that with total certainty, and anyone claiming otherwise is guessing just like the rest of us. But the far more interesting question, the one actually worth your time, is this. Are the ingredients for another major move genuinely beginning to align beneath the surface? Based on the latest thinking from Matt Hougan and Tom Lee, the answer is increasingly worth watching closely, even if it's not a guaranteed outcome. Hougan's thesis says the institutional wave is still relatively early, despite how far crypto has already come. Lee's thesis says Ethereum could become one of the foundational rails underneath tokenized finance and artificial intelligence. And right now, the market is genuinely starting to test both of those theories with real capital, not just with opinions. Bitcoin has already pushed back toward the $80,000 area this week. Ethereum has started showing renewed relative leadership at points during that same stretch. ETF flows are coming back into sharp focus for both assets. And macro liquidity expectations are actively shifting underneath everything else we've discussed today. None of that guarantees a straight line higher from here. In fact, there will probably be real volatility along the way. There could be sharp pullbacks that shake weaker hands out of positions. There could be another fake breakout that traps people buying the top. There could even be a sudden risk-off event tied to something completely unrelated to crypto itself. But here's the part I want you to actually remember after this video ends. If the next wave of capital arrives while the market is already positioned for higher prices, the resulting move could end up becoming much larger than the initial catalyst itself would suggest on paper. And that's really the true story underneath all of this. Not simply Bitcoin to the moon, in some vague, meaningless sense. Not Ethereum is guaranteed to hit some magic round number by some arbitrary date. The real story is the ongoing transition of crypto from a speculative corner of finance that mostly attracted retail traders into something increasingly embedded inside the core financial system itself. Bitcoin represents one side of that transition. Ethereum represents another complementary side of the same story. Matt Hougan and Tom Lee are essentially pointing at two different pieces of the exact same puzzle. One is focused on the capital flowing into this entire asset class. The other is focused on the infrastructure quietly being built underneath it, brick by brick, month by month. If both of those forces accelerate at the same time, that's genuinely when things get very interesting for anyone paying attention. Before you go, quick question, and I'd actually love an honest answer in the comments. How's the weather where you're watching this from right now? I ask that on purpose, because I want to know how spread out this audience actually is across the world, and it always surprises me how many different time zones end up in one comment section. Remember the 7 signals we walked through today. ETF flows, Ethereum flows specifically, the relative strength relationship between the two assets, treasury yields, the dollar, stablecoin growth, and institutional tokenization announcements. Watch those 7 things, not the headlines screaming at you every single morning. Because the biggest move in this market may not begin with some dramatic, attention-grabbing headline at all. It may begin quietly, with capital moving weeks before the crowd even realizes what's actually happening underneath the surface. And if Hougan is right about institutional adoption continuing to build, and Lee is right about Ethereum's expanding role in tokenization and artificial intelligence, then the next phase of this market could genuinely look very different from the last one we all just lived through. The real question isn't whether Bitcoin and Ethereum can move higher from here. They obviously can, and history has shown that repeatedly. The real question is whether the next wave of institutional capital is finally arriving at the exact same moment that the underlying financial infrastructure is being built out beneath it. And if it is, September could genuinely look very different from August. If this video actually helped you understand what's really happening underneath the headlines, hit like so this reaches more people who need to see it instead of the usual noise. Subscribe if you want more breakdowns like this one, without the hype and without someone screaming price targets at you for engagement. And if you know someone who's been asking you about Bitcoin or Ethereum lately, share this with them instead of trying to explain all of this yourself. Comment below and tell me which side of this story you're leaning toward right now, Bitcoin's scarcity thesis, Ethereum's infrastructure thesis, or genuinely both at the same time. I read every single comment on these videos, and I want to know where this community actually stands heading into September. This is not financial advice. Crypto assets remain highly volatile and speculative, and forecasts from market commentators, including everyone mentioned in this video, can absolutely be wrong. Always do your own research and consider your own personal risk tolerance before making any investment decision. This has been The Wealth Continuum. I'll see you in the next one.